When a balance sheet and an income statement are presented, a statement of cash flows is required for each income statement period. The purpose of the statement of cash flows is to provide information about the cash receipts and cash disbursements of an enterprise. Similar to the income statement, it's a change statement summarizing the transactions that affected cash during the period. The term cash refers to cash plus cash equivalents. We discussed the difference between cash and accrual basis accounting in Chapter 1, and it was pointed out and illustrated that over short periods of time, operating cash flows may not be indicative of the company's long-run cash-generating ability, and that accrual-based net income provides a more accurate prediction of future cash flows. But nevertheless, information about cash flows from operating activities, when combined with information about cash flows from other activities, can provide information helpful in assessing future profitability, liquidity, and long-term solvency. A company must pay its debts with cash, not with income. Of particular importance is the amount of cash generated from operating activities. In the long run, a company must be able to generate positive cash flow from activities related to selling its product or service. These activities must provide the necessary cash to pay debts, provide dividends to shareholders, and provide for future growth. A list of cash flows is more meaningful to investors and creditors if they can determine the type of transaction that gave rise to those cash flows. The statement of cash flows classifies all transactions affecting cash into one of three categories: operating activities, investing activities, and financing activities. So let's look at a question here. Which of the following is true concerning the statement of cash flows? A, the statement of cash flows can provide information helpful in assessing future profitability, liquidity, and solvency. B, the statement of cash flows shows cash receipts and cash disbursements of an enterprise. C, the statement of cash flows is required to be presented for any period for which an income statement is presented. Or D, all of these are true. All of those are true. The inflows and the outflows of cash that result from activities reported in the income statement are classified as cash flows from operating activities. This classification of cash flows includes the elements of net income reported on a cash basis rather than an accrual basis. Cash inflows include cash received from customers for sale of goods and services and interest and dividends from investments. These amounts may differ from sales and investment income reported in the income statement. So like an example is when sales revenue measured on the accrual basis reflects revenue earned during the period, it's not necessarily the cash that was actually collected. Revenue will not equal cash collected from customers if receivables from customers or deferred revenue changed during the period. Cash outflows would include cash paid for the purchase of inventory, salaries, wages, and other operating expenses, interest on debt, income taxes. These amounts also may differ from the corresponding accrual expenses reported in the income statement. Expenses are reported when incurred, not necessarily when cash is actually paid for those expenses. Also, some revenue and expenses like depreciation expense don't affect cash at all, and they're not included as cash outflows from operating activities since cash wasn't included in that. The difference between the inflows and outflows is called net cash flows from operating activities. This is equivalent to net income if the income statement had been prepared on a cash basis rather than an accrual basis method. So there are two generally accepted formats that can be used to report operating activities: the direct method and the indirect method. Under the direct method, the cash effect of each operating activity is reported directly in the statement. For example, cash received from customers is reported as the cash effect of sales activities. Income statement transactions that have no cash flow effects, such as depreciation, are just not reported. By the indirect method, on the other hand, we arrive at net cash flow from operating activities indirectly by starting with reported net income and then working backwards to convert that amount to a cash basis. Two types of adjustments to net income are needed in this method. Components of net income that do not affect cash get reversed. That means that non-cash revenues and gains are subtracted while non-cash expenses and losses are added. For example, depreciation expense does not reduce cash, but it is subtracted in the income statement. So to reverse this, we add back depreciation expense to net income to arrive at the amount that we would have had if depreciation hadn't been subtracted. Second, we make adjustments for changes in operating assets and liabilities during the period that indicate that amounts included as components of net income are not the same as cash flows for those components. So for instance, suppose accounts receivable increases during the period because cash collected from customers is less than the sales revenue. Well, this increase in accounts receivable would then be subtracted from net income to arrive at cash flow from operating activities. In the indirect method, positive adjustments to net income are made for decreases in related assets and increases in related liabilities, while negative adjustments are made for increases in those assets and decreases in those liabilities. So to contrast the direct and indirect methods, let's consider the example in this slide. Let's start with the direct method. So from the income statement, we see that ALC's net income has 4 components. 3 of those, the service revenue, general and administrative expenses, and income tax expense, affect cash flows, but not by the accrual amounts reported in the income statement. One component, depreciation, reduces net income, but not cash. It's simply an allocation over time of a prior year's expenditure for a depreciable asset. To report these operating activities on a cash basis rather than an accrual basis, we take the 3 items that affect cash and adjust the amounts to reflect cash inflow rather than revenue earned and cash outflows rather than expenses that have incurred. Let's start with service revenue. Service revenue is $90,000, but ALC did not collect that much cash from its customers. We know that because accounts receivable increased from 0 to $12,000. ALC must have collected to date only $78,000 of the amount earned. General and administrative expenses of $32,000 were incurred, but $7,000 of those have not yet been paid. We know that because accounts payable increased by $7,000. Also, prepaid insurance increased by $4,000, so ALC must have paid $4,000 more cash for insurance coverage than the amount that expired and was reported as insurance expense. That means cash paid thus far for general and administrative expenses was only $29,000, which would be the $32,000 less the $7,000 increase in accounts payable plus the $4,000 increase in prepaid insurance. The other expense, income tax, was $15,000, but that's the amount by which income taxes payable increased, so no cash has been paid for income taxes. We can report ALC's cash flow from operating activities using the direct method as we see here. Now, to report operating cash flows using the indirect method, we take a different approach. We start with ALC's net income, but we realize that the $35,000 both includes cash and non-cash components. We need to adjust net income, then eliminate the non-cash effects, so we've only got the cash flows. We start by eliminating the only non-cash component of net income. In this slide, it's depreciation expense. Depreciation of $8,000 was subtracted in the income statement, so to eliminate its negative effect on net income, we just add it back. That leaves us with three components of net income that don't affect cash, that do affect cash, but not necessarily by the amounts reported. Service revenue, general and administrative expense, and income tax expense. For those, we need to make adjustments to net income to cause it to reflect cash flows rather than accrual amounts. So for instance, we saw earlier that even though $90,000 in service revenue is reflected in net income, only $78,000 cash was received from customers. That means we need to include an adjustment to reduce net income by $12,000, the increase in the accounts receivable. We also include adjustments for the changes in prepaid insurance, accounts payable, and income tax payable to adjust net income to reflect cash payments rather than expenses incurred. For prepaid insurance, because interest expense in the income statement was less than the cash paid for interest, we need to subtract the difference, which equals the increase in prepaid insurance. If this asset had decreased, we would have added rather than subtracted the change. For accounts payable and taxes payable, because the related expense in the income statement was more than cash paid for those expenses, we need to add back the differences. If these liabilities had decreased, then we would have subtracted rather than added the changes. Cash flows from operating activities using the indirect method are shown here. Both the direct and the indirect methods will ultimately produce the same net cash flows from operating activities of $49,000 shown on the slide. They're just different approaches to reporting the cash flows. The FASB, regarding GAAP for the statement of cash flows, stated its preference for the direct method. However, while both methods are used in practice, the direct method really doesn't get used much. The choice of presentation method for cash flow from operating activities has no effect on how investing activities and financing activities are reported. Cash flows from investing activities include inflows and outflows of cash related to the acquisition and disposition of long-lived assets used in the operations of the business, such as property, plant, and equipment. And then also investment activities, except those classified as cash equivalents and trading securities. The purchase and sale of inventories aren't considered investing activities. Inventories are purchased for the purpose of being sold as part of the company's operations. So purchases and sales of inventory get included in operating activities. Cash outflows from investing activities include cash paid for the purchase of long-lived assets used in business. The purchase of investment securities like stocks and bonds of other entities, other than those classified as cash equivalents and trading securities, are included here. And then loans to other entities. When the assets then get disposed of, cash inflows from the sale of the assets or collection of loans and notes also gets reported as cash flows from investing activities. As a result, cash inflows from these transactions are considered investing activities. The sale of long-lived assets used in business, the sale of investment securities other than the cash equivalents and trading securities, and the collection of a non-trade receivable, excluding the collection of interest, which would be an operating activity. Net cash flows from investing activities represents the difference between the inflows and the outflows. Last, we have our financing activities. These relate to the external financing of the company. Cash inflows occur when the cash is borrowed from creditors or invested by owners. Cash outflows occur when cash is paid back to creditors or distributed to owners. The payment of interest to a creditor gets classified as an operating activity. Cash inflows include cash received from owners when shares are sold to them, or creditors when cash is borrowed through notes, loans, mortgages, and bonds. Cash outflows include cash paid to owners in the form of dividends or other distributions, owners for the reacquisition of shares previously sold, and creditors as repayment of the principal amounts of debt, excluding trade payables that relate to operating activities. Net cash flows from financing activities is the difference between the inflows and those outflows. So this slide shows the 2018 statement of cash flows for ALC, beginning with net cash flows from operating activities. We know $40,000 was paid to buy equipment because that balance sheet account increased from no balance to $40,000. Also, because common stock increased from 0 to $50,000, we include that amount as a cash flow, which is an inflow from financing activities. Finally, $5,000 was paid as a cash dividend, which is also a financing activity. The statement of cash flows helps provide useful information about the investing and financing activities where a company is engaged. Even though these primarily result in cash inflows and cash outflows, there may be significant investing and financing activities occurring during the period that do not involve cash flows at all. In order to provide complete information about these activities, any significant non-cash investing or financing activities, which are non-cash exchanges, are reported either on the face of the statement of cash flows or in a disclosure note. An example of a significant non-cash investing or financing activity is the acquisition of equipment, which would be an investing activity, by issuing either a long-term note payable or equity security, a financing activity. So let's take a look at an exercise. The following summary transactions occurred during year 1 for Peach Pink Bakers. We have our cash received from customers, our interest on notes receivable, principal on notes receivable, sale of investments, and proceeds from notes payable. Then the cash that went out, we paid purchase of inventory, interest on a note payable, purchase of equipment, salaries to employees, principal on the note payable, and then the payment of dividends to shareholders. The balance of cash and cash equivalents at the beginning of the year was $25,000. So we're going to create a statement of cash flows using the direct method for reporting operating activities. So as you see here, we're going to begin by using the operating activities and start with cash flows from operating. This relates to the current activities of a company. We're going to start by the collection from customers. From there, the interest on the note receivable. Remember, the note receivable will be put elsewhere, but the interest on it is an operating activity. The principal of the note receivable is an investing activity. We lent money out, and now we're receiving it back. The sale of investments is also an investing activity. But the proceeds of a note payable would be a financing activity. Purchasing inventory, of course, would be an operating activity. The interest on the note payable is an operating activity, while the receipt or payment of a note payable would be a financing activity. Purchase of equipment is an investing activity. Salaries paid to employees would be an operating activity that's in the normal course of a business. The principal on the note payable is a financing activity. And also the payment of dividends to shareholders would also be a financing activity. So we show the net cash flows from each activity. We net the net cash flows from operating activities, from investing activities, and the net cash flows from financing activities. We come up with a net increase or decrease in cash. We then take our beginning balance to come up with what our ending balance will be. That will be shown on the balance sheet. Another exercise, we've got the statement of cash flows from Denver Metals. We're going to prepare the statement of cash flows assuming that Denver prepares its financial statements according to the International Financial Reporting Standards. That allows more flexibility. Use the classifications used most often in the IFRS financial statements. So, with GAAP, we show dividends received, interest paid. On financing activities, we show our dividends paid. But with IFRS, it's a little different. We show the investing activities will show our dividends and interest received, and our financing activities would show our dividends and interest paid. So the difference with GAAP and IFRS is that in GAAP, the dividends received and the interest received are reported under operating, whereas in IFRS it's not. So using IFRS as with the statement of cash flows, the difference you're going to notice will be the interest and the dividends received will be reported under the investing activities. Ultimately, we're going to have the same balance, but those two items and the interest on the note payable, instead of it being in operating, will be put as a reduction in financing activities. Next, presented below is the Year 2 income statement and comparative balance sheet information for Tiger Enterprises. We are going to prepare a cash flows from operating activities section of Tiger's Year 2 statement of cash flows using the direct method. Assume that all purchases and sales of inventory are on account and that there are no anticipated bad debts for accounts receivable. So here we see the information related to the income statement, and then we see the information related to 2 comparative years of the balance sheet. So we see here that accounts receivable in year 1 are $820,000. In year 2, the accounts receivable is $741,000. So we see here that it has decreased during the year. We had $7,100 of monies that came in during the year, $7,100, that then showed a decrease in the accounts receivable. So $7,100 were our sales revenues, which were debited to accounts receivable. So we have to back in to decide what was paid in accounts receivable, what was received in cash, to then derive our ending balance in accounts receivable of $741,000. So if we started the year of $820, we know we had sales of $7,100 all on account because it told us that. we know our ending balance in accounts receivable is $741. We then need to determine what the credit would have been to accounts receivable, which is the $71.79. So, the same with insurance expense. We have a prepaid balance in year one of $24,000. The end of the year, we have $60,000 in a prepaid expense. Our insurance expense was $130,000, which means we had used up insurance during the year that had expired of $130,000. So what was recorded to prepaid insurance during the year that gave us an ending balance of $60,000? We can plug that figure in to determine the information that's presented in the balance sheet and the income statement. The $24,000 plus we must have had $166,000 in prepaid insurance, because our income statement shows we used up $130,000 of it to end up with an ending balance in prepaid insurance of $60,000. Also, as we look at accounts payable and inventory and cost of goods sold, this involves computing it with three different T accounts. We show our cost of goods sold during the year of $3,048,000. We began the year with $540,000 in inventory, and we know we ended the year with a balance of $576,000 in inventory. Also, we know our accounts payable began the year with $410,000 of inventory and ended the year with $342,000 of inventory. If our inventory that transferred to cost of goods sold is $3,048,000, we know that happened because we credited our inventory to then debit our cost of goods sold. So what is the figure that was put into inventory during the year to ultimately derive an ending balance of $576,000? We know that had to be the beginning balance plus the amounts debited to inventory minus the amounts that went into cost of goods sold to come up with our ending inventory balance. Also, we can see what we ended up paying against our payables because we started the year with $410,000. We added to that payable the inventory we purchased. We know what we had to have paid out in accounts payable to end our accounts payable balance at the end of the year of $342,000. So the $3,152,000 is what we ultimately paid out in inventory during the year. Again, when we look at our admin and other expenses, our income statement shows $1,820,000. But our admin and other payables shows we began the year at $380,000. We ended the year at $285,000. We know that when we incurred those admin and other expenses, we debited our expense and we credited our payable. So how much of that was paid during the year would have been a debit to our payables account, showing that it was the $1,915 that was actually paid in those expenses. Last, we show an income tax expense of $593,000 on the income statement. But our income taxes payable began with $120,000 and ended with 160. We know that income tax expense was accrued, so how much was paid in income taxes during the year that we paid out? Well, the 120 plus the 593 minus what would give us 160,000 in our income tax payable. That would be the 553,000. So we've got our various T accounts that show the monies we actually received in and the monies we actually paid out. So our collections from customers is actually in cash the $71.79 that we computed. Our prepayment of insurance would be the $166 that we paid out. Our payment to inventory suppliers, $31.52, and then our payment for admin and other expenses of $19.15, along with the amount we paid into income taxes, would then give us our net cash flows from operating activities of $1,393. Let's take a look at a question. Which of the following items would not be included as a cash flow from operating activities in a statement of cash flows? Purchase of inventory, we know would be in the operating section. Purchase of machinery, remember, that is an investing activity. The payment of income taxes and the collection on a note would be in operating activities. Next, Bledsoe Motors reported revenue of $7,500,000 for its year ended December 31st. Accounts receivable at December 2017 and $18,000 respectively were $480,000 and $532,000. That means that our accounts receivable increased during the year, which means that there were more revenues that were on account during the year. Using the direct method for reporting cash flows from operating activities, Bledsoe Motors would report cash collected from customers of $7.5 million, $7.525 million, $7,567,500, or $7,447,700. So the way in which we're going to compute this is we're going to take our 480 at the beginning of the year receivables plus the $7,500,000 of revenues during the year minus our accounts receivable that we show at the end of the year to figure out what cash was truly collected in revenues for the period. Another one, Kringle Pastries reported net income of $432,000 for its year ended December 31st. Purchases of merchandise totaled $304,000. Accounts payable balances at the beginning were $72,000 and at the end $66,000. So that shows we paid out more of the accounts payable because it went down. Beginning and ending inventory balances were $88,000 and $92,000 respectively. Assuming that all relevant information has been presented, what would Kringle Pastries report of operating cash flows? So, as you can see here, the correct answer is C, $422,000. We start by our net income of $432,000. Our inventory increased by $4,000. So the inventory went from $88,000 to $92,000. We're going to subtract that amount. Our accounts payable decreased. It went from $72,000 to $66,000. Therefore, we're going to decrease the accounts payable to show cash flows from operating activities of $422,000. Now let's take a look at exercise 420. Presented below is the year 2 of income statement and comparative balance sheet for Langard Enterprises. So we've got the income statement here and our balance sheet. We are required to prepare the statement of cash flows using the indirect method to present cash flows from operating activities. So again, an important piece here will be to see the change in accounts receivable, the change in inventory, the change in prepaid insurance, the change in accounts payable, the change in payables for administrative and other expenses, and income tax payable. We'll also look at our income statement to see what was shown on our income statement and then adjust those figures to those balance sheet items. So we start with our net income of $889,000. Then we adjust for changes in some of those balance sheet items. Depreciation expense is a non-cash expense that we will add back. We didn't need cash to show that depreciation expense, therefore we add it back. Changes in operating assets and liabilities. Since our accounts receivable decreased from year 1 to year 2. As a result of the fact it decreased, we're going to add $79,000 back. Think about this. If our accounts receivable was at $820,000 in year 1, but then reduced to $741,000 in year 2, then that means more customers paid in extra to reduce that accounts receivable, which resulted in greater cash. Next, when we have an increase in inventory, we're going to subtract it. Assets that decrease, we add. Assets that increase from one year to the next, we subtract. We had an increase in prepaid insurance, therefore we subtract. Now the opposite is true with liabilities. When we have a decrease in a liability, we subtract, and when we have an increase in a liability, we add. Therefore, we had a decrease in the payables, we subtract. If we have an increase in the income taxes payable, we're going to add. So our net cash flows from operating activities, about $1,033,000. The purchase of plant and equipment is a subtraction because we used up cash. And then proceeds from a note payable, that increases our cash, so we add that. Also, proceeds from an issuance of stock is an increase to our cash. Payment of dividends. We use up money when we pay out dividends. Now, in order to determine those dividends that we paid, we're going to show the retained earnings at the first year. We're going to add our net income, subtract our retained earnings to figure out how much in fact was paid out in dividends. Net cash flows from financing activities of minus $586,000. We add those three columns to get those three lines in the second column together to get our net increase in cash. We start with year 1 in cash, which we show as $240,000. the net increase in cash plus our cash from January 1 should equal our balance as of the end of year 2. Like U.S. GAAP, international standards also require a statement of cash flows. Consistent with U.S. GAAP, cash flows are classified as operating, investing, or financing. However, the U.S. standard designates cash outflows for interest payments and cash inflows from interest and dividends received that they should be shown as operating cash flows. Dividends paid to shareholders get classified as financing cash flows. Well, in IFRS, companies can report interest and dividends paid as either operating or financing cash flows, and interest and dividends received as either operating or investing cash flows. Interest and dividend payments usually are reported as financing activities. Interest and dividends received normally are classified as investing activities. So in Siemens, a German company, it prepares its financial statements according to IFRS. In its statement of cash flows for the first 3 months of 2014's fiscal year, the company reported interest and dividends received as operating cash flows, as a U.S. company would. However, Siemens classified interest paid as a financing cash flow. So let's take a look at this question. Which of the following is accurate concerning presentation of financial statements in regard to IFRS compliance? Unlike U.S. GAAP, IFRS requires certain minimum information to be disclosed on the face of the income statement. U.S. GAAP and IFRS display interest and dividends differently in the statement of cash flows. Both U.S. GAAP and IFRS allows companies to report comprehensive income as a single statement or in 2 separate statements. Or D, all of these answers are correct. Well, I hope you get this one. They're all correct. Now, Chapter 3 provided an overview of various financial statement analysis, and it introduced some common ratios that were used in risk analysis to look at a company's liquidity and long-term solvency. Now, we're going to look at some profitability analysis ratios. One key to profitability is how well a company manages and utilizes its assets. Some ratios are designed to evaluate the company's effectiveness in managing assets. Some interests are the activity or turnover ratio of certain assets. The greater the number of times an asset turns over, which is the higher the ratio, the fewer assets are required to maintain a given level of revenues. Therefore, high turnovers are usually preferred. Although in concept the activity or turnover can be measured for any asset, activity ratios are more frequently calculated for total assets, accounts receivable, and for inventory. A convenient extension is the average collection period. This measure is computed by simply dividing 365 days by the receivables turnover ratio. The result is an approximation of the number of days the average accounts receivable balance is outstanding. Monitoring the receivables turnover ratio and average collection period over time provides useful information about a company's future prospects. So a decline in the receivables turnover ratio, which means an increase in the average collection period, might show sales are declining because of customer dissatisfaction with company products. Another explanation is that the company's changed its credit policy and is granting extended credit terms in order to keep customers. Either explanation could signal a future increase in some bad debts. While ratio analysis does not explain what's wrong, it does provide information that highlights areas for further investigation. An important activity measure for a merchandising company, which is like a retail or wholesale or manufacturing company, is what we call the inventory turnover ratio. The ratio shows the number of times the average inventory balance is sold during a reporting period. It indicates how quickly inventory is sold. The more frequently a business is able to sell or turn over its inventory, the lower its investment in inventory must be for a given level of sales. The ratio is computed by dividing the period's cost of goods sold by the average inventory balance. The denominator, average inventory, is determined by adding beginning and ending inventory and dividing it by 2. A relatively high ratio compared to a competitor is desirable. A high ratio indicates comparative strength, perhaps caused by a company's superior sales force or maybe a successful advertising campaign. But it might also be caused by a relatively low inventory level, which could mean either very efficient inventory management or stockouts and lost sales in the future. On the other hand, a relatively low ratio or a decrease in the ratio over time usually is perceived to be unfavorable. Too much capital could be tied up in inventory. A relatively low ratio may result from overstocking, the presence of obsolete items, or poor marketing and sales efforts. Similar to the receivables turnover, we can divide the inventory turnover ratio into 365 days to compute the average days in inventory. This measure indicates the number of days it normally takes to sell inventory. A fundamental element of an analyst's task is to develop an understanding of a firm's profitability. Now, profitability ratios attempt to measure a company's ability to earn an adequate return relative to sales or resources devoted to operations. Resources devoted to operations can be defined as total assets or only those assets provided by owners, depending on the evaluation objective. The 3 common profitability measures are shown here: profit margin on sales, return on assets, and return on stockholders' equity. All the profitability ratios, our numerator will always be net income. The relevance of any historically based financial statement hinges on its predictive value. To enhance predictive value, analysts often adjust net income in these ratios to separate a company's transitory earnings effect from its permanent earnings. Analysts begin their assessment of permanent earnings with income from continuing operations. Then adjustments are made for any unusual one-time gains or losses that are included in income from continuing operations. It is this adjusted number they use as the numerator in these ratios. Equity investors are concerned about the amount of profit that management can generate from the resources that owners provide. A closely watched measure that captures this is ROE, return on equity. This is calculated by dividing net income by the average stockholders' equity. In addition to monitoring return on equity, investors want to understand how that return can be improved. So the DuPont framework provides a convenient basis for analysts that break return on equity into 3 key components: profitability, activity, and financial leverage. So profitability is measured by the profit margin, which is net income divided by sales. A higher profit margin indicates that a company generates more profit from each dollar of sales. Activity is measured by asset turnover, sales divided by average total assets. The higher asset turnover, it indicates that a company uses its assets efficiently to generate more sales from each dollar of assets. Financial leverage is measured by the equity multiplier, average total assets divided by average total equity. A high equity multiplier indicates that relatively more of the company's assets have been financed with debt, which means the company's more leveraged. Leverage can provide additional return to the company's equity holders, but it also can provide greater risk. Notice that total sales and average total assets appear in the numerator of one ratio and the denominator of another ratio. So they cancel to yield net income divided by average total assets, give us our return on equity. So you've seen ROA is determined by profit margin and asset turnover. So another way to compute return on equity is just by multiplying ROA by the equity multiplier. You see from this equation that an equity multiplier of greater than 1 will produce a return on equity that's higher than the return on assets. Like, as with all ratio analysis, there are trade-offs. If leverage is too high, creditors get concerned about the potential default on the company's debt and then require higher interest rates. Because interest gets recognized as an expense, net income gets reduced, so then at some point the benefits of the higher equity multiplier are offset by a lower profit margin. Part of the challenge of managing a company is to identify the combination of profitability, activity, and leverage that produces the highest return for equity holders. The equation form of the DuPont framework helps demonstrate this. So let's take a look at a question here. Harrington's Pet Supplies begins the year with an inventory balance of $220,000. At year-end, the inventory balance was $185,000. Cost of goods sold for the year was $900,000. Calculate the inventory turnover ratio and average days in inventory. So, as you see here, the way in which we're going to handle this, we're going to take our 220 plus the 185, divide that by 2, which gives us 4.44. The number of days in inventory would be by taking our 365 days, divided that by the ratio, gives us 82.21 days items are in inventory. Let's look at interim reporting for Sherwin-Williams. Financial statements covering periods of less than a year are called interim reports. Companies that are registered with the SEC must submit quarterly reports. Though there's no requirement to do so, most send these quarterly reports to shareholders and use abbreviated or unaudited interim reports as supplemental information within their annual reports. Here we see information for Sherwin-Williams, a company that sells paint and manufactures it, amounts for each of the 4 quarters summed to the reported amounts for the full year. For accounting information to be useful, it must be available on a timely basis. So one of the objectives of interim reporting is to enhance timeliness of financial information. Quarterly reports provide investors and creditors with additional insight on the seasonality of business operations that might otherwise get lost in those annual reports. So why are sales and net income higher in the second and third quarters compared to the first and fourth for Sherwin? Most outside painting occurs in warmer months. These months occur in the second and third quarters, so it is expected sales are going to be higher in these quarters. Because the company sells paint for a profit, profitability also gets higher in the quarters where there's greater sales. But the downside to these benefits is the relative unreliability of interim reporting. With a shorter reporting period, questions associated about estimation and allocation get magnified. While certain expenses often benefit an entire year's operation, and yet are incurred primarily within a single interim period. Should smaller companies use lower tax rates in the earlier quarters and higher rates in later quarters, as higher tax brackets are reached? Another result of shorter reporting periods is the intensified effects of unusual events like material gains and losses. A second quarter casualty loss, that would be an example that would reduce annual profits by 10%, might reduce second quarter profitability by 40% or more. It's more realistic to allocate this loss over the entire year. These and similar questions tend to hinge on the way we view an interim period in relation to the fiscal year. More specifically, should each interim period be viewed as a discrete reporting period, or probably it should be reviewed as an integral part of the annual report? Existing practice and current reporting requirements for interim reporting generally follow the viewpoint interim reports are an integral part of annual statements, although the discrete approach is applied in some items. Most revenues and expenses are recognized using the same accounting principles applicable to annual reporting. Some modifications are necessary to help cause interim statements to relate better to annual statements. This is most evident in the way costs and expenses are recognized. Most are recognized as interim periods as incurred. But when an expenditure clearly benefits more than just one period in which it's incurred, the expense should be allocated among the periods benefited on an allocation basis consistent with the company's annual allocation procedures. Like an example, annual repair expenses, property tax expense, advertising expenses in the first quarter that clearly benefit later quarters are assigned to each quarter through the use of accruals and deferrals. Costs and expenses subject to year-end adjustments like depreciation are estimated and allocated to interim periods in a systematic way. Income tax expense at each interim date should be based on estimates of the effective rate for the whole year. This would mean that if the estimated effective rate has changed since the previous interim periods, then the tax expense period would be determined as the new rate times the cumulative pre-tax income to date, less the total tax expense reported in previous interim periods. On the other hand, major events such as discontinued operations should be reported separately in the interim period in which they incur. These amounts should not be allocated among individual quarters within the fiscal year. The same is true for items that are unusual. Treatment of these items is more consistent with the discrete view than the integral part view. A second item that's treated in a manner consistent with the discrete view is earnings per share. EPS calculations for interim reports follow the same procedures as annual calculations. The calculations are based on conditions actually existing during the particular interim period rather than on conditions estimated to exist at just the end of the fiscal year. Remember, we account for a change in accounting principle retrospectively, which recasts the prior year's financial statements when we report those statements in comparative form. So we make those statements appear as if the newly adopted accounting method had been used in those prior years. It's the same with interim reporting. We respectively report a change made during an interim period in similar fashion. In financial reports of subsequent interim periods of the same fiscal year, we disclose how that change affected income from operations continuing, net income, and related per share amounts for the post-change interim period. Complete financial statements aren't required for interim reporting, but certain minimum disclosures are: sales, income tax and net income, earnings per share, seasonal revenue costs and expenses, significant changes in estimates for income taxes, contingencies, discontinued operations and unusual or infrequent items, changes in accounting principle or estimates, information about fair value of financial instruments and the methods and assumptions used to help estimate those fair values, and then significant changes in financial position. When fourth quarter results are not separately reported, material fourth quarter events, including year-end adjustments, should be reported in disclosure notes to the annual statement. IAS number 34 requires that a company apply the same accounting policies in its interim financial statements as it applies in its annual financial statements. So IFRS takes much more of a discrete period approach than does our GAAP. For example, costs for repairs and property taxes and advertising that don't meet the definition of an asset at the end of an interim period are expensed entirely in the period in which they occur under IFRS. But they're accrued or deferred and then charged to each of the periods they benefit under US GAAP. This difference would tend to make interim period income more volatile under IFRS than it would under GAAP. However, as is in US GAAP, income taxes are accounted for based on an estimate of the tax rate expected to be applied to the entire year. So let's look at some ratios. The following is a portion of the condensed income statement for SearchWeb for Amber Inc., a manufacturer of plastic containers. We're supposed to determine Rowan's inventory turnover. So the way we'll do this is we take the cost of goods sold, divide that by our average inventory. Our cost of goods sold will be the beginning inventory plus the ending inventory divided by 2. So we take our inventory on January 1st plus our inventory on December 31st, divide that by 2, which means our average cost of goods sold, our average inventory here is $663,500. Our cost of goods sold is provided in the income statement of $1,863,000. We divide that by our average inventory to give us the inventory turnover of 2.81 times a year. Now, next one, the following information was reported by Dynaxo Toys. Determine the following ratios for year 2. Profit margin on sales, return on assets, and return on shareholders' equity. Then we'll determine the amounts of dividends that were paid to shareholders in year 2. So our profit margin is our net income divided by net sales. Our net income in year 2 is $222. Divide that by our net sales of $4,600. Gives us our profit margin of 4.8%. Our return on assets is going to be our net income divided by our average total assets. Well, our average total assets would be what we began the year with, $2,020,000 plus our $1,770 divided by 2, which gives us the $1,895. So our ROA is 11.7%. Next, our return on shareholders' equity is going to be our net income divided by our average shareholders' equity. We take the beginning of the period plus the end of the period, divide that also by 2. Our return on shareholders' equity is 29.2%. How much was paid in dividends to shareholders? We can figure that out by taking our beginning retained earnings, add our net income, we know our ending retained earnings, and that should then provide us with what is the missing amount in dividends that brings us down to the ending retained earnings. Next, Vidal Toys shows information for year 1 and 2. We're going to take the following components of using the DuPont framework to calculate our profit margin on sales, our asset turnover, our equity multiplier, our return on shareholders' equity, and then write an equation that relates to these components in calculating our return on equity. So, as you see here for profit margin, we're going to take our net income and divide it by net sales to come up with 3.69%. Next, our asset turnover is going to be our net sales divided by our beginning assets plus our ending assets divided by 2 gives us asset turnover of 2.6. Our equity multiplier is our average total assets divided by our average shareholders' equity. So, the shareholders' equity, you know, consists of 2 components, paid-in capital and retained earnings. So we're going to take the average shareholders' equity for year 1 plus year 2, divide that by 2 to come up with an average. Same true with average total assets. We're going to take our beginning average total assets plus our ending, divide that by 2. So our equity multiplier is going to be the 1960 divided by the 730 to give us 2.68. Last, our return on shareholders' equity is going to be our net income divided by our average shareholders' equity to give us 25.71%. So the equation that relates to these components would be our profit margin on sales, our asset turnover, our equity multiplier, and ultimately our return on assets. As you see here, our return on equity, do you see how the net sales cancel out here? Our average total assets cancel out here. So ultimately, our net income divided by our average total equity is ultimately what can give us our ROE, our return on equity. Again, 25.71%. There you have it. This is a pretty heavy chapter for Chapter 4. Take your time, review, and go through all the exercises. You guys have